If the Fed raises interest rates, how much will that really affect you, the consumer? To get an idea, the Wall Street Journal takes a look at the past reactions of a few key consumer savings and borrowing rates when the Fed previously hiked rates. Wall Street Journal senior special writer James Sterngold joins us now to discuss. Hi, Jim. Great to have you here. There's a lot of talk, when the Fed finally raises rates, it will finally benefit all those savers who've been waiting for this moment. But if we look at the recent past, deposit rates don't quite react that way, do they?
Absolutely not. The historical record is crystal clear, and I'm afraid it's a good news, bad news situation. Good news for the banks, they get a pop immediately. Not so good news for you and me and consumers. Our rates that we save at are going to basically stay the same, barely budge, but what we pay for loans, that goes up immediately.
And what about credit card rates?
Credit card rates are probably going to tick up. Some of that is already built in because we've been waiting for these increases, of course, for a couple of years. But credit card rates are likely to tick up. It's going to cost us more.
So that savings account is not going to balloon anytime soon.
Absolutely not. This has been a real problem, of course, for savers for a long time.
Right. All right. Now, looking at the 30-year fixed mortgage, that rate is tied to a couple other things as well, correct?
That's right. That's a little more complicated calculations. Since it's 30 years, it's tied to a longer-term rate as a benchmark, and that's usually the 10-year Treasury. And it also is more related to inflation. So that may tick up. In fact, if you look again at the historical record, there's often a brief uptrend, but then it really does stick more to those longer-term rates and inflation rate.
And there have been some cases where it's actually fallen as the Fed tightens, correct?
Exactly. And again, that tends to relate to the so-called long end of the curve and expectations about inflation.
So we can't really predict too much about where mortgage rates will go.
No, but if you talk to people in the business, they'll generally say that the expectation is so clear that the Fed's going to move goodness knows when, but sometime this year, that it's pretty much already built into mortgage rates, which are roughly 4-ish% for a 30-year loan.
Right. All right. Now, looking at car loans, I mean, certainly there have been a lot of those in the past few years. Will a rate hike cut into some of those sales?
That's a tricky one. Those tend to be shorter term. They're 3 years, 5 years, that kind of thing. And clearly, cheap money has helped car sales a lot. There is a concern that they will tick up a little bit. Not clear it's going to be a lot, particularly if the Fed just moves 25 basis points or a quarter of a percentage point. But that could cause somewhat of an uptick, and particularly for weaker borrowers who are just making it, that's where you could see an impact.
And so, Jim, how quickly will any of these changes trickle down to consumers?
Instantly.
Instantly?
The banks will waste about 3 nanoseconds thinking about it, and then they will act. So usually they expect that pop to happen same day. You'll see banks raise prime rate in that.
Is that partially because, as you said earlier, they are the ones who benefit the most?
Absolutely. They're not going to waste any time taking that extra money.
All right, James, thank you so much for that.